In the last video, you guys learned the language of Forex. Now, let's move on to the next step and getting you set up to actually start the trade. We're going to cover brokers, trading platforms, how to practice safely on demo accounts, and then we'll dive into the very first skill every trader needs before getting into charts: candlesticks. By the end of this video, you should know exactly how to start trading without getting scammed or overwhelmed. In the Forex market, you will need a broker. That's the middleman that connects you to the markets, so you can actually open and close trades. But not all brokers are the same, and that's very important to remember. There are two main types of brokers that you will hear about: market makers and ESN or STP brokers. Market makers are brokers that often create their own pricing and act as a counterparty to your trade. That just means when you buy, they're the ones selling to you. Now, not all market makers are bad, but some have been known to manipulate spreads, delay your entries, or even hunt your stop loss. They can also make it hard to withdraw your profits. Now, that's obviously not too ideal if you're trying to take trading seriously. Now, ESN or STP brokers, these are generally preferred by more experienced traders. They route your trades directly to the market makers or the liquidity providers, meaning they do not act as a counterparty to your trades. Execution under this type of broker is usually cleaner. Spreads are tighter, and it feels more like a real market environment. However, usually this type of broker requires a large amount of capital to get in. Now, here's where you need to be careful. Do your research very well before choosing a broker. Ask yourself and research, are they regulated? How fast and how often can you withdraw your money? Do they have a history of delaying payouts? Do they mess with spreads or execution? There are a lot of shady brokers out there, especially now, and they can make the process of withdrawing your money pretty hard. Some have delayed payouts for a month, for a year, some never get their money out. So it's very crucial that you pick the right broker to work with. That being said, there are plenty of good brokers. Personally, I've been using Hero FX for a very long time now. They're reliable, I've never had any issues withdrawing my money. You can get payouts daily, which is pretty rare. No commissions on trades, executions are pretty smooth, and the support team is the best. So if you're looking for a place to start, check the link in the description below and you'll get a bonus. You'll get 10x your deposit. Now, in terms of platforms, the most common ones you'll hear about are MT4, MetaTrader 4, MT5, MetaTrader 5, and cTrader. Now, these are the platforms where you actually place your trades, monitor positions, set stop losses, set take profits, etc, etc. Now, MT4 and MT5 are the most widely known and used because they're beginner friendly, especially in the Forex market. They're also mobile friendly, so you can trade on the go, which is very helpful. Now, for charting and analysis, most traders, myself included, use TradingView. It's web-based, super clean, and pretty easy to draw levels and do analysis on it. Now, my advice is start off with a demo account. Learn how the platform of your choosing works and check out the user interface. Understand how to enter and exit trades, mess around with lot sizes, just figure it all out. Now, do not think about going live until you know how to set stop losses and take profits at the bare minimum. And pro tip, when you do go live, start small. As small as possible. The goal here is not to flip $100 to 10K overnight. I remember I had a wealth manager when I was working at the hedge fund always tell me, if you want to be a good trader, survive first, profit second. That stuck with me, and I really hope it sticks with you too. The goal of going live with a very small starting capital is to test yourself, your discipline and consistency, with real money on the line, real emotions. Alright, with brokers and platforms out the way, let's get into the most fundamental part of Forex trading, the candlesticks. If you've ever looked at a chart before, you've seen those small green and red blocks with sticks coming out either side. That's what we're talking about here. This is where reading price action begins. Each block or candlestick represents a price movement over a certain period of time. Could be 1 minute, 5 minutes, 1 hour, 4 hours, 1 day, a week, or even a month. All depends on the time frame you're looking at. But the structure is always the same. So what exactly does one candlestick tell you? Every single candlestick shows 4 main pieces of information. 1, the open, where the price started at the beginning of that candle. 2, the close, where the price ended when that candle finished. 3, the high, the highest price point reached during that candle. And number 4, the low, the lowest point price dipped to during that candle. If the close is higher than the open, that candle is considered bullish. That means buyers were in control and price moved up. These are usually colored green or white. If the close is lower than the open, that candle is considered bearish. That means sellers had control and price dropped. Bearish candles are usually colored red or black. Now, what about those lines on top and bottom? Those are called the Wicks. The Wicks, also called shadows, show price extremes. The top wick shows the highest price buyers could get to before sellers stepped in. The bottom wick shows how far sellers pushed down before buyers stepped in. Now, these wicks or extremes may seem insignificant at first, but they tell us a lot about market sentiment. For example, if you see a candle with a very long upper wick but a bearish close, that tells you that buyers tried to push the price up but sellers stepped in. That's called a rejection. And a rejection typically shows potential weakness in buying pressure. So you're asking yourself, why does this matter? Because candlestick charts are a visual representation of psychology. They're not just random shapes or visuals. They're telling you who's in control in that moment of time. Is it buyers or sellers? When you begin to really read and understand candles, you begin to know what the market is thinking and what it's doing without needing to slap on many different indicators on your chart. So let's take a look at a few examples at a chart. You'll start to notice some very specific patterns keep popping up no matter what pair, no matter what time frame you use. Learning candlesticks is step 1 to mastering and understanding price action. You don't have to overcomplicate it or use 20 different indicators, especially at first. So just start with this. Understand what the candle is trying to tell you, and you'll be ahead of 90% of retail traders out there already. In the next section, we're diving into chart patterns and market structure. But none of that matters if you guys don't understand the basic candle. So replay that part if you have to, but just make sure you understand it very well before moving on. And remember, every trade you'll ever take will start off by reading what the candle tells you. Alright, now that you understand candlesticks and what they mean and what they are, let's zoom out a bit and look at the bigger picture. Trends. Because no, the market does not move randomly. It moves in trends. And if you don't understand the overall trend, you're just gambling. There are only 3 types of market trends: upwards, downwards, and sideways. Master them, understand them. The first trend is an uptrend. An uptrend consists of higher highs and higher lows. When the market's going up, it never goes up in a straight line. You'll see price push up, come back down a bit, and push up higher. That is called an uptrend. Now, as mentioned, the most obvious characteristic of this type of trend is each high is higher than the previous high, and each low is higher than the previous low. When the market's in an uptrend, you'll be looking for buy setups. Number 2, downtrend. Same concept as the uptrend, just flipped. A downtrend is when price keeps making lower highs and lower lows. In a downtrend, sellers are in control. Every time price tries to bounce up, sellers slap it back down again. In downtrends, you want to be looking for sell setups. And the third type of a market trend is a sideways trend or ranging. In this type of trend, price is stuck between support and resistance. No real direction here. No higher highs, no lower lows, just choppy. This is where most new traders will lose money, because even though there is no trend, they try to trade as if there is. Now, there is a golden rule when it comes to trends. You always trade with the trend, never against it. If price is trending up, you buy the dips. If price is trending down, you sell the pops. If the market is ranging or sideways, you either sell out completely or you try to scalp. However, for beginners, I don't recommend that. If you do try to short an uptrend, you may find that it keeps ripping against you, and that's because you're going against the momentum of the market. Don't do that yet. Not until you're a professional trader with very tight risk control. So here's a few practical tips on how you can identify trends. Look at structure. Are we making higher highs and higher lows, lower highs? Later on in the series, we'll go way deeper into indicators. But a quick tool that I can tell you about right now that can help you spot trends is the 50-day EMA. Price above the 50 EMA with a bullish structure means that probably we're trending upwards. The price below it and we're making lower lows, probably trending downward. Now, trading trends may sound simple, and to be honest, it kind of is. But simple does not mean easy. The challenge is not going to be spotting the trend exactly. The challenge will be spotting it and then staying patient enough to know when to enter and when to exit. Just keep this in mind. In an uptrend, you're looking to buy. In a downtrend, you're looking to sell. If the market is ranging or choppy, just sit out for now. So now we've learned. Candles and trends show you what's happening in the market. However, supply and demand show you why and when it's going to happen. So in the next video, I'll be breaking down supply and demand super simply for you guys, and also showing you how you can build your own trading edge so you can start seeing profits as soon as possible. So don't forget to like, subscribe, and hit that notification button so you guys don't miss the next video.